and welcome to Market Domination. I'm Julie Hyman, Josh Lipton, back live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
So much of what's going on right now will likely only be realized several months down the line. The numbers right now from an earnings perspective seem to be shaping up pretty good. I mean, pretty well. They're actually looking better than they did at the start of the quarter, at least for a year-over-year growth, from a year-over-year growth perspective. What I'm very curious about is forward guidance, particularly from those quote-unquote Magnificent Seven.
And the real big release of the week is going to be payrolls on Friday. You know, how's the labor market faring with all of this uncertainty and, threats of tariffs? What we have seen anecdotally is companies have said that they've just basically paused their operations, whether it's investment or hiring. That takes an impact on employment that we'll get on Friday.
I think it's pretty much game over for NVIDIA in China. I think the ban of the H20 was probably the final straw of NVIDIA being able to sell anything halfway decent into China, and I would expect that Huawei's products will probably be higher quality than the older products that NVIDIA has been shipping, or the H20, if not today, then at some point in the near future. So I do think NVIDIA's pretty much cut off, and I do think of NVIDIA from here on out as much more of a developed market story. There's still plenty of growth in the US, Europe, so I'm much more focused on those markets at this point.
We got 1 hour to go until the market close. So we're taking a look at the major averages here, which are a little bit down, but more of a sort of, it feels like an in-between kind of day. After last week's big rally that we saw for the major averages, the Dow today, we're just seeing very little change at the moment. The S&P 500 down just about 1/4%, and the NASDAQ is off about 0.5%.
Yeah, it's just generally bit more calmer out there. You can see in the bond market too, Julie. I just saw the 10-year was right around, I checked 4.22. So a bit calmer out there today. Of course, the question is this really, the calm before the storm, Julie?
Well,
you got big
yes.
earnings on deck, right? You got big tech on deck. You got Meta and Microsoft. You got Amazon and Apple. I thought it was interesting. David Rosenberg, who we both know, noted skeptic of Rosenberg Research. He told his clients this morning. He said tech stocks, Rosie said, look more favorable now on a risk-reward basis after this recent drawdown, which I did think was interesting and notable. And of course, that's just earnings. Then you got the economic data. You got jobs. You got inflation. You got economic growth. So you got a full calendar this week.
Yeah, that GDP report is going to be really interesting, especially since there's been so much debate about whether there was actually a contraction in growth in the first quarter. So we'll get the details on that, at least the first read on that on Wednesday morning. You talked about big tech. Let's take a look at how those stocks are trading today. We see a mixed picture there as well. Tesla resuming its slide here. Alphabet sliding a little bit after a lift following earnings last week. Amazon down ahead of its numbers. And then, of course, there is NVIDIA. Now, we just heard Brian Colello of Morningstar and what he told our morning team today about these reports that Huawei is developing some competitor chips to NVIDIA. Now, analysts have told us in the past NVIDIA was effectively shut out of that market anyway, and then indeed the export ban on the H120 was sort of the final straw of that. Investors seem to have largely discounted that already, but nonetheless, the stock is down about 3% today on the back of some of the reporting.
Yeah, and it raises all kinds of, I think it's interesting because there's all these broader questions too, policy questions, Julie, about, China would like to be this tech powerhouse. The U.S. government would prefer they not be. And so we have these policy tools, we have export controls. The question is do those work, or do you actually wind up encouraging, incentivizing more creativity and innovation among the Chinese names, among the Huawei's?
Yeah, it's a great question. And by the way, if you look at the broader semiconductor universe today, we're mostly seeing declines. I mean, Broadcom's little change, Intel is up a little bit, and NXP Semiconductor, which when we had Lou Bassanese on the show last week, this is one he likes. It reports after the close of trading, but seeing some pretty broad selling there today. Elsewhere, it's pretty mixed when you look at the sectors in today's session. You got consumer staples down the most, energy up the most, but again, not very big moves today as we have this sort of wait and see for big tech and economic
Not
data.
big moves, but a big guest to talk all about it. For more on the latest market moves, let's welcome in now Ryan Dietrich, Chief Market Strategist at Carson Group, which manages over $4 billion in assets. Ryan, it is always great to see you on the show, my friend. You say something interesting, Ryan. I want to start here. You say, you know what? The lows of the year could now be in. That's what you're telling your clients, Ryan. How come? Walk me through that. I'm curious, what are the indicators you're watching?
Yeah, thank you for having me, guys. There's so much to talk about here. We'll see if we can get it all out there. When you think about it, we're up like 14% or so off those lows that we hit a couple weeks ago. But just last week, right? I'm sure you had some other guests point some of these things out, but I'm going to go over them again. We had that Zweig breadth thrust. What in the world is that? It's how many stocks go up versus down on the NYSE. What we're looking for is a 10-day EMA, super oversold, and then super overbought within a 2-week period. I know that's a mouthful. Just think like this: really oversold to really overbought short term. It triggered last Thursday. Where this matters for the listeners and viewers, S&P's been higher a year later since World War II, 19 out of 19 times. 6 months later, higher, 19 out of 19 times. I mean, that's just one indicator, but that's pretty positive. I'll give you one more, and then we can talk a little more. S&P was up 1.5% 3 days in a row last week. I believe it was Tuesday, Wednesday, Thursday. 1 year after that, it's only happened 10 times. If there were more, I'd share, but only 10 times. 1 year later, higher, 10 times, up well over 20%. There's other stuff we can get into, but I think last week we had multiple buying thrusts that potentially suggest, again, the lows are in, and doesn't mean it's going to be easy. Doesn't mean we're going to go straight up. I want to be very clear there, but the lows of the year are likely in here.
So, Ryan, I know you love to talk technical indicators, but I got to ask a question about the fundamentals too, which is, in order for stocks to not just bump along here, but to actually move meaningfully higher, what would need to happen from a fundamental perspective?
Yeah, I mean, I wish I had a really smart answer, but I think it's as simple as trade. We need to see more concrete news out of trade. We think we're inching closer to that, Julie. I mean, earnings season hasn't been great. You played like I guess a clip of a previous guest right before I came on talking about, listen, the Mag 7's coming up, right? I mean, what do they see in the future here? What are they feeling? I mean, Google did a pretty, or I guess it's called Alphabet now. Alphabet did a pretty good job with what they had to say. What are the rest of them going to say? But at the end of the day, it does come down to trade. Now, one more thing on the economy, and I know I've talked to you guys about this a lot the last few months. When we look at credit spreads, like investment grade corporate spreads and triple B spreads, keep this real simple. What we were seeing, the credit markets were never really worried. I know the market was down on a bear market. I know Mag 7 was down 30, 40%. We get all that. But the credit markets have never shown major stress, and that can change in a hurry. I get it. But that's a sign to us that, you can have bear markets without recessions. We pretty much just had one. We've had them before. We'll have them again. And that's, again, why we think the credit markets, smartest guys in the room, we think that's a sign that the rest of this year, stocks are going to bounce back pretty nicely.
And for the economy, Ryan, I'm curious what you see over 2025. Are you in the slowdown camp, the cooling camp? Are you in the odds of recession or rising camp? Walk us through it.
Yeah, I mean, clearly the odds to a recession, Josh, over the last, let's call it 6 weeks, are higher, right? I mean, it started this year, we were probably, say, about 15%, so about 1 out of 6, which is kind of your average year. Now, I mean, next 12 months, we're maybe 30% or so that's not our base case, right? We were overweight equities coming into this year. We've lowered some of that. We're still overweight, but not as much as we were. But the reality, one of the real-time indicators, and you mentioned, again, Friday, right? Or a guest before me mentioned Friday, obviously a big day with the monthly jobs number. But one of the positive things that are out there in our view is those weekly initial jobless claims. We haven't seen a spike yet, and it can change. I get it. We were 225,000 initial jobless claims last week, or I guess it would have been 2 weeks ago, announced last week. But the reality is that's still kind of at the bottom of the range. So until we see spikes in initial jobless claims, I'm not saying the economy's great. It's slowing down. We might have a negative print in the first quarter coming up here on Thursday. Honestly, just remember, that's old news. Markets only cares about what's forward. It's still something we're going to talk about. We know we have a slowdown here, Josh. One more thing on this. You look at the last 10 years, the first quarter historically is like the worst quarter for GDP. And I don't know if there's quirks in there. I don't know. I'm not an economist. I just know the data. The data says it's normal to get a weak first quarter, and then you kind of bounce back. I mean, I think that's probably what we're going to have again this year.
Ryan, I want to go back to big tech earnings, which, as we've been talking about, we're going to get 4 of the 7 Magnificent 7 this week. And there was a chart from Lori Calvasina this morning, RBC strategist, where she looked at the differential between U.S. X Mag 7, the S&P 500 X Mag 7, and the Mag 7. And that basically, this is something we've been talking a lot about, that the other 493 are expected to start to pick up more of the earnings growth slack as the Mag 7 slow down. Is that still the base case? And is that what happens from a stock performance perspective as this transition's going on?
Nah, that's a great question there. We think it will continue, right? I mean, you call it, I guess, the 493, if you will, are going to finally come back. We know this time 2 years ago and last year was all about Mag 7. That's where most of the growth and earnings growth were coming from. But it has been, broadening out, I guess is what I want to say. Now with the market acting the way it's been, it's a little different, but we think a broadening out still makes sense. I mean, the time we're doing this, financials are like up on the year. Financials gained 34% last year. That's a really, really important group that's out there. And they've had some pretty solid earnings. So it's nice to see that broadening out from a technical point of view, but also from an economic point of view. Let's put a bow on this, though. We know the Mag 7 matters, right? I mean, they're so influential. We all know that. Every listener knows that. So it's important what they say, but it is nice to see a lot of other companies that are doing pretty good. But the key thing is guidance, and nobody's that comfortable giving significant guidance right now, and that's why the market's murky at best. But again, going forward, let's say, the rest of this year, let's see those other 493 play some catch up is going to be a positive, we think.
So Ryan, bottom line, I know you remain overweight equities. I'm curious, when you look overseas, what interests you, if anything?
Mm-hmm. Oh, absolutely. So when I say overweight equities, people think I just mean like Mag 7 or US. No, I mean, in our unconstrained tactical models that we run, it's a mouthful, I know, but we can do anything we want. We're about 74% equities right now. But when you kind of peel back that onion, Josh, we've got a good deal of European exposure in there. We added some European exposure a couple weeks ago, right? We've got more European exposure than most benchmarks. We have things like low volatility. This is not European, but we have like low volatility and momentum. We got like a barbelled paired trade in there. So we're not just when I was coming on with you guys 2 years ago, we were like 91, 92% equities in some of the models we run. So we've dialed that back. But again, we think there's opportunity specifically in Europe. And one more thing on this. I mean, listen, the time we're doing this, I'm not sure if it officially happened or not, but really close. German DAX is like at an all-time high. I mean, it's really close if it's not there. It's hard for us to think there's this global calamity coming when one of the most important stock markets in the world is flirting with all-time highs. And what Germany announced a few months ago with all the fiscal stimulus coming, those are some reasons we've been dipping our toe into developed international, specifically Europe, in the money that we run for our Carson partners.
Ryan, great to catch up with you as always. Thank you.
See you guys. Thank you.
The U.S. economy has defied a recession so far. Some economists do think that could change. Yahoo Finance Alexander Canal joins us now with more. Ali, we've almost become conditioned over the past couple of years to predictions of an economic slowdown that haven't quite materialized.
Yeah, if you look at 22, 23, post-COVID pandemic, all economists out there were screaming from the rooftops that we were going to enter a recession, especially since the Fed was tightening with aggressively high interest rates. That ultimately did not happen. So I'm curious whether or not we could see that materialize this time around. And talking to a lot of these economists out there, yes, recession odds have increased, but it's not necessarily fully baked into their base case yet because there's all this uncertainty surrounding tariffs, and any quick U-turn from the administration, that's going to drastically change the outlook. So I wanted to focus in on the labor market specifically. When we look at that, economists have told me that businesses are actually quite confident that the administration is going to really not commit as aggressively as they have promised on some of these reciprocal tariffs. Now, the one thing that businesses have learned from past recessions, that once you commit to aggressive layoffs, it's very difficult to reverse those. So they're trying not to make any sudden moves until they have some more clarity on that front. Now, when I talk the timeline of that, it's not the next few months. It's not around Liberation Day. It's really the next few weeks. That's when they need to start to see some clarity. Now, regardless of that, if they start to see sales getting hit, obviously that's going to lead to some weakness in the labor market. If we think about different indicators that are out there, Ryan Dietrich was just talking about jobless claims. That's held up. We are still below 300,000. We have seen hiring freezes, particularly when we think about sectors like travel. But really, it's the real-time corporate commentary on these earnings calls that economists are really zoning in on, because when it comes to labor market, there's really not a perfect indicator, right? A lot of things are lagged. And when you think about, too, things like jobless claims, if you're laid off from a big corporation, you're probably getting severance. We're in a tight labor market. You're probably putting your energy into finding jobs. Maybe you're not filing for those unemployment benefits. So sometimes it doesn't tell the full picture there. So really, when we look ahead, recessions can happen fast. If we get a negative non-farm payroll print, we're probably already behind the 8 ball, but there's not much out there that we can look to really give us the full picture of things. So it's sort of just grasping at all these anecdotal stories and trying to really pay attention to what corporations are telling us.
When you spoke to these economists, Ali, were there certain specific metrics that they were focused on the most, concentrating on the most right now?
They said jobless claims are probably your best bet. But again, even look what's going on with all the Doge layoffs, right? Things in DC, that has been all over the place because we have severance packages and we have these corporate buyouts and things like that. So we're not totally getting the full picture, and we'll probably see more over the coming months, maybe in the second quarter. That's really the timeline here. Towards the end of Q2 is when we could see potentially some weakness. But in terms of indicators, look at those earnings calls, really see what management is saying. If they're finding any evidence of layoffs, or if they're exploring that, if they are freezing hiring, that in aggregate is going to give you more of a better picture than some of these indicators. You know, we have ADP coming up, a lot of chatter about the Challenger data. That's a lot of noise right now, and it seems like these economists are not so much focused on those types of surveys.
Interesting. Thanks so much, Ali.
Of course.
Appreciate it. We're just getting started here on Market Domination. Coming up, we've got a loaded earnings week on tap. On the other side of the break, we'll hear from an analyst to preview what to expect from Apple and Amazon on earnings. Plus, NVIDIA stocks falling as China's Huawei reportedly readies AI chips. We'll check in on some of today's top trading tickers later in the hour. Stick around. Much more Market Domination still to come. It has been a rough quarter for Apple with tariffs, supply chain issues, and the company still recovering from a botched Apple Intelligence rollout in the view of many investors. Apple is reporting earnings after the close on Thursday, and our next guest says it is one of the most anticipated earnings calls for Apple ever. For more, we're bringing in Tom Forte, Managing Director and Senior Consumer Internet Analyst at Maxim Group. Tom, it's great to see you. One of the most anticipated ever. Talk to me about why that is, please.
Yeah, so as a longtime follower of the company, dating back to when Steve Jobs ran it, I'm very curious to see how Tim Cook is going to manage tariffs, supply chain, and all the issues that are facing the company. I was very, interested to see that they shipped $2 billion of iPhones from India as a way to mitigate the tariff impact. So I think this is must-watch TV, must-listen to earnings call. I'm very much looking forward to it.
Tom, I was speaking to another Apple analyst today, smart, longtime Apple watcher like yourself, Tom, and he really thought, listen, he agreed. He thinks tariffs are front and center this quarter for Apple. It'll be tariff question after tariff question on the call, he thinks. I guess, how you are thinking through it yourself, though, Tom. I mean, the question is going to be posed to Tim Cook in some fashion of basically like just how are you navigating the potential Trump tariff impact? What is the strategy? What is the game plan? What do you think he's going to say there?
So 3 thoughts. So listening to Tesla last week, Josh, it occurred to me, could Apple do something similar, which is make its products on a regional basis like Tesla's doing? So could they make iPhones both in the US and China and India? The challenge there would be being able to do it at a reasonable cost in the US. Second, I think when it comes to tariffs, it's ultimately how much can a company rely on suppliers to bear the incremental cost? How much of the incremental cost will the company bear itself? And how much will they attempt to pass on to consumers? And in that regard, I think Apple has, premium brand, sells higher priced items. So they do have some pricing pressure or pricing power, but certainly an interesting situation for Apple.
I mean, there's pricing power and then there's pricing power, Tom. I mean, we've heard estimates from some of your peers on the street about how much producing phones in the U.S. could cost in terms of the finished product. And we're talking huge figures here. We're talking maybe a doubling of price. Do you think that's an exaggeration? And do you think that consumers would bear that cost, would be willing to pay it?
I don't think it's an exaggeration as far as, if there's 100% tariff on items made out of China, Apple's items are not exempt. How much could that increase the cost if an iPhone were made in the US? At the same time, though, I think some of the narrative on Apple is just too negative. So what you've seen in many instances is that the carriers are bearing the incremental cost. They're passing on heavy promotions to consumers. So I think they're, while I think the next 12 months and 18 months is challenging for Apple, if you look at the things that have happened in the past, such as a high level of promotional activity by the carriers, or simply moving production to a lower tariff country, India versus China. So I think it's going to be challenging, but perhaps maybe not as challenging as some people fear.
Tom, the stock is down heading into this print. It's down about 15% year to date. I mean, how much of the potential bad news do you think is already priced in here?
Yeah, so I think, Josh, you hit the nail on the head there, which is the quarterly earnings is really all about how much of the bad news is priced in there. So they had a double-digit decline in sales to China in the December quarter. Let's assume they had another double-digit decline in the March quarter and are on pace for another double-digit decline in the June quarter, and then margin compression from tariffs. I think that down 15% might be tested. There is potential that the near-term performance could be even weaker than that, and maybe the shares come under pressure on Thursday.
Tom, I want to switch gears and ask you about Amazon as well, because here's a company that is also exposed to tariffs, particularly its third-party sellers are going to be exposed to tariffs. We've already heard, for example, some Chinese sellers of goods in the U.S., like Shein and Temu, saying that they are going to make some changes here ahead of the de minimis tax exemption going away. So what do you think this all means for Amazon?
Yeah, so same challenge for Amazon. How much of the incremental cost will be borne by the sellers, Amazon itself, and how much will be passed on to consumers? I think what you're going to see is initially they're going to try to pass the costs on to consumers. Then the question will be, how soft will sales get? And will they continue to be able to pass on price increases, meaning the sellers? So it looks like there may be fewer promotions for Prime Day, weaker sales for Amazon. But what's really important for the stock is enterprise sales holding up well, especially as it pertains to cloud computing. So when you think about the potential for a recession, if you see weakness there, and then also if you see weakness in their advertising revenue, high margin, high growth, I think that's what could slow shares of Amazon more so than a weaker consumer environment when you think of the relative importance of the cloud computing and advertising business versus e-commerce for Amazon.
I'm curious, Tom, heading into this print, when it comes to hyperscalers, the cloud giants, there was, reports, rumors, hot talk, Tom, you saw it about, whether we were seeing a slowdown in AI capital spending. I'm curious what you make of that.
What I make of it is, I wish they would acknowledge what they would do if their dollars went less far. So one of the other challenges for tariffs for Amazon, as an example, which is committed to spending $100 billion in CapEx this year to advance their AI efforts, is what if all the chips and all the components that are part of that spend are now more expensive because of tariffs? Do they raise the $100 billion in spend, or do they acknowledge that they're not getting as much capital equipment from the $100 billion? That's what I would like to hear, but so far I've not heard from anyone in earnings so far.
We'll be listening closely. Tom, thanks so much. Appreciate it.
Thank you.
And tune in on Thursday for Yahoo Finance special coverage of Apple earnings. Coverage begins at 4:30 p.m. Eastern here. And as Tom said, it's going to be much-watched TV, so you don't want to miss it. Now time for some of today's trending tickers. We're checking in on shares of NVIDIA, Coinbase, and Domino's Pizza. Let's start with that Magnificent Seven darling NVIDIA. Shares falling today after the Wall Street Journal reported that China's Huawei is reportedly testing a new artificial intelligence chip to rival NVIDIA's. Now, to be clear here, this is not a chip that's going to rival Blackwell, for example, the most advanced chips that NVIDIA sells that it can't sell in China anyway. It's more targeted at the H120, which is the most recent chip that the U.S. has said that NVIDIA is not able to sell there.
Yeah, journals citing sources saying here that Huawei has approached some Chinese companies about testing. It sounds like the feasibility of the new chip. Paper says it's still early stages here. More tests will be required to assess performance, get it ready for customers. China accounted for about 13% of NVIDIA's revenue in its fiscal year 25. It's per analyst. Stock is down about 20% this year. Of course, most of that, we were just talking to Forte, Tom about this, is a lot due to investors raising just questions about AI spending now and ahead and how that would impact names like NVIDIA.
Yeah, that's definitely part of it.
Shares of Coinbase, meanwhile, are getting hit today. That's on the back of a double downgrade from Compass Point, lowering the stock from buy to sell, citing concerns ahead of the company's upcoming first quarter earnings results. That's on May 8th. So Compass Point Research does do the double downgrade. They skip hold. They go to the sell, concerned about second half performance as growth comes from lower margin institutional segments, they said, and also noted decentralized exchanges could take market share among retail traders, they argue, target 180.
Something else I found intriguing here is they said that Coinbase is losing its status as the only pure play non-BTC crypto stock. They seem to have, the folks at Compass Point, a little bit more be in the Bitcoin maximalist camp, and so they actually like strategy, aka MicroStrategy, because they have a buy on that and they're recommending a sell on coin, sort of a pair trade, if you will, on the two of these. They say, we believe this trade replicates the Bitcoin dominance trade. So interesting flavor there as well.
Coin shares, they say, have reacted negatively to its three most recent earnings results. Told clients we expect this streak to continue after disappointing Q1 results and second quarter commentary.
Yes, so we'll see what they say on May 8th. And lastly, we've got Domino's Pizza in focus today. That company reported mixed results in its first quarter, with revenue narrowly missing while profit topped expectations. The pizza giant reaffirming full-year guidance, emphasizing global expansion to navigate the ongoing U.S. consumer caution. The shares up right now. They've been kind of bouncing around in a narrow range here today because, you know, they're kind of playing a wait and see, it looks like.
Yeah, Bloomberg analysts chiming in too here. They said 2025 U.S. same-store sales guidance of 3% may be achievable. They talked about DoorDash partnership, stuffed crust pizza, and greater loyalty member sales will be partly offset, they talk about, by soft, low-income consumer spending.
International same-store sales, by the way, were stronger in the quarter.
I saw that, yeah.
Than they were in the U.S. They beat analyst estimates, but we saw in the U.S. same-store sales were down by 0.5%.
To the extent that you were getting nervous about the economy in your pocketbook, see, I would think people would be like, okay, maybe I'll skip the steak and I'll head to a Domino's.
Maybe they're cooking at home.
Or you
Who
just do it
knows?
all at home. Yeah,
I guess.
could be. All right, coming up, President Donald Trump's first 100 days back in office have clearly transformed America's political landscape. So what is next? We're going to speak to an expert on the side. Stick around. Much more market domination. That's still to come.
We are nearing President Donald Trump's first 100 days in office, and while his return has clearly transformed America's political landscape, a wide range of big-ticket items are still looming. For more on the start of Trump's second term as president and what's to come, let's welcome in Matthew Aks, Evercore ISI senior strategist based there in D.C., has formerly worked in government as well, so we really appreciate your perspective here, Matt. So before all these other big ticket items, it seems like we should talk about tariffs and just linger on this one for a moment, because it is the thing that he has come out with a bang and then some. What do market participants now most closely need to watch from a policy perspective around tariffs in the coming weeks and months?
It's great to be with you. Well, look, I think tariffs clearly have peaked. And the administration is looking for a way to come down off of those highs you saw after the so-called Liberation Day. I think the question is just how quickly they can effectuate that without feeling like they've lost face. We know that the administration is working on memorandums of understanding, or Secretary Besson called them agreements of understanding, with a set of countries. But I think market participants really need to watch how substantive are those agreements, just how much breathing room do they buy for negotiations to unfold. And if they don't buy enough time or create enough certainty, then unfortunately I think this environment we've been operating in of high uncertainty is likely to continue.
So Matt, tariffs front and center for investors, so are taxes. I'm curious, Matt, those Trump tax cuts, in your opinion, Matt, are they getting extended? And if so, when you're talking to your clients, what do you think the timeline is?
Yeah, well, look, I think on the timeline, we're going to get a very important update here from Secretary Besson in a few days, potentially a few weeks, around when he expects to hit the debt limit. We know that the debt limit is riding along with the tax cut extensions, and I think that'll really frame up the legislative calendar here, looking ahead into May and into the summer. I expect that they're going to try to pass Trump's, so-called one big beautiful bill by around that time when they would hit the debt limit, and just try to deal with everything at once, extend the tax cuts, provide additional tax cuts, and also deal with the debt limit in kind of one full sweep.
The backdrop for this, of course, is that sentiment around Trump's performance has been worsening, particularly with regard to the economy. It was there that we saw quite a dramatic pullback in approval ratings. And so what does that mean for, I guess, both the president's ability, but also the pressure on him to make that bill happen?
Yeah, well, look, I think one of the most interesting aspects of this first 100 days has been that the president seems far less focused on near-term market and economic performance than I think we saw in his first term and the sort of Trump we all got to know back when he was first serving. I do think that to the extent the economy continues to weaken due to the tariffs and the trade-related policy uncertainty, I think Congress, I don't know that they're going to directly check the president on tariffs or try to vote to overturn any of the Trump tariffs. I think what it just leads them to do is to really try to amp up that tax cut and try to, as best they can, to kind of offset some of the drag we're seeing from trade through the tax channel.
On Congressman, I'm curious, what is GOP support like right now on Capitol Hill for Trump? How firm, how strong is it, Matt? Do you have line of sight there?
Yeah, well, look, I think the GOP under Trump in Congress right now, it's important to think of it. Trump is very powerful, has a great hold over his party, but there still are different factions, different coalitions that make up that Republican tent. I think for now, most folks don't quite want to get into a head-to-head confrontation with Trump, recognizing that he won the election, he won a full sweep in Congress, and has a mandate for some period of time here to try to carry out the full scope of his agenda in terms of what he promised to do. So I don't think you'll see anyone really taking him on directly. But I do think frustration and concern will continue to build, especially in a few weeks if we start to see some of the negative impacts of tariffs that some economists have started to warn about.
And sorry, to come back to the tax bill, whether we're talking about, I think it's going to be really important for markets whether you just get an extension or whether you get an extension plus. And so what's the sort of the base case for whether the plus, the other things on the agenda that Trump and the GOP have pushed for, whether those things are coming?
Yeah, look, I think they will get a decent sized plus on top of what most expect, which is just the extensions. The Senate framework creates a good chunk of room to do that. It does seem like the House is sort of coming to terms with adopting the Senate framework, which will lead to more tax relief. But I think there's a big question of just how much do they try to jam into that framework. There are different ways of structuring it. You could do more or less of that. And I think to some degree, members will be watching the deficit, will be watching the bond markets as well. And I think they'll try to find that sweet spot where they're providing the right amount of relief for the economy and to try to maintain some of that support, while at the same time not going so far that you provoke an adverse reaction from the bond markets.
Matt, I get you out of this. What did you just make of Trump seeming to kind of flirt with the idea of raising taxes on millionaires? When you heard that, Matt, your response, your reaction?
Well, I think it's certainly a signal of just how far the Republican Party has evolved. I remember I was serving in government during 2012 when we had the fiscal cliff then. And in a lot of ways, the fiscal cliff then basically focused on that exact question. And I think the Republican side was adamant that they did not want to see taxes go up on top earners. And that was really what much of the debate back then focused on. So I think it's indicative of a new populist shift in the Republican Party, which is animating not just tax policy, but a whole host of areas. It does seem like Trump has now backed off that idea. But I do think, again, as they continue to develop the bill, especially if it's looking like they're going to go down the road of having some Medicaid cuts, they'll be looking for other ways to show that they're still aligned with working class voters.
Matt, great to see you on the show today. Thanks so much for joining us. Appreciate it.
Thanks so much for having me.
Tesla shares looking to extend 4 consecutive days of gains. The EV maker, however, having a tough start to the year, we know. First quarter earnings disappointing the street, as sales are also seeing a drop. But our next guest highlighting that $300 level for Tesla may be back in play. Barron's associator Al Root joining us now to discuss. Al, always good to see you on set.
Hi, guys.
So let's talk about, first of all, that level, 300. Why are we watching that line in the sand?
Well, this goes to, with Tesla especially, I like to look at the stock charts as well as the fundamentals because you sort of need all hands on deck when looking at this one, right? And, through the election, we went to 490 and then we went all the way back down to 220. We got basically through the 100-day moving average today, or maybe it was the 200-day. And then, 300, that puts 300 in play, and then sort of the next resistance would be 360. And why do we talk about this? Market technicians aren't necessarily looking at making fundamental calls on Tesla stock. But when you deal with a stock like Tesla, and you think, oh, it's 90 times earnings, the rest of the Mag 7, oh, the quarter wasn't very good, oh, Elon's coming back, and you're trying to put this all together, what the reaction can be, the stock charts are very helpful. So once we closed above 280 on Friday, I mean, you're looking at 300, you're looking at 360 in this sort of snapback in, oh goodness, things aren't as bad as I feared sentiment.
And I mean, what is the sentiment around Tesla generally? Because after the earnings, even though he said he's coming back, like we all know that the first quarter was pretty bad, and it doesn't, the early indications are not that there's going to be a big bounce in sales, for example.
So, I mean, first quarter was terrible, right? So, the regulatory credits, we like to pick on these, $525 million. It was more than operating profit. So the regulatory credit sales accounted for more than 100%. That was the first time since the second quarter of 2020 that has happened. So the car business is really tough. We all know the story, 337,000 deliveries. Is it Elon? Is it brand damage? Is it the Model Y changeover? So we are expecting, the street is expecting, 410,000 deliveries for Q2, so an improvement. Tesla, famously abandoned their goal to grow sales in 25 in that first quarter report. But Elon coming back, and he didn't fully come back, right. But 1 to 2 days in Washington with more focus on Tesla, you can see what impact that has. We've all heard the line, Tesla is Elon and Elon is Tesla. So it's like the savior is coming home for at least part of the week. And then so now we're going to do the robo-taxis in June. If he does that, again, that helps sentiment. Yeah. And if they launch a legitimate new model this year that frankly isn't sort of a cheaper version of the 3 that's another positive. That'll help sentiment. So we're just sort of riding waves of sentiment at this moment, but we're improving.
If we get that more relatively affordable model, what would you expect demand to be like for that model? How would it sort of compare and contrast with the competition?
Well, two answers. So if it's a legitimately new model, and so I think that the street and investors think it's some sort of derivative off the Cybercab, something smaller, $30,000, maybe before the tax credits, which are still in place. I think the demand would be very good. It would be a full new market segment, right? So you would be looking at, you could sell hundreds of thousands of these in the US, and you could sell multiples of that globally, be a really good car. Because Tesla doesn't address all of the automotive market, right? You talk about Chinese competition and what's been happening in the market share. They don't play in most of the market, right? They have no smaller car. If it's just a, let's just say it's a Model Y, but we have cloth seats, and no leather seats, no seat heaters, and there you go, it's $30,000. I don't think that would be very good at all for the stock. I think that would start to shift sentiment because it cannibalizes sales. I am an example of this. As soon as they offered a cheapo rear-wheel drive long-range Model Y, I jumped on that because I couldn't get the big one.
Right, well, and people kept telling us last week, don't wait for that. Just buy a used Tesla because they're being marked way down right now instead of waiting for this mythical, cheaper model that's coming out. I'm going to call an audible, Al, and ask you, because we've all been covering this craziness over the past couple of months now in markets. And as somebody who's been doing this, we've all been doing this a long time. How are you surfing through? What's been sort of the most interesting thread for you to pull on as this has all been going on?
So the most interesting thread, tariffs dominate everything almost, right? We're talking about cars. There's a number of things, right? And I suppose you could extend this to defense, and I'll use the word chaos. It's just so chaotic. The best example, or one of my favorite stories this year, is this idea of, well, if profits are going to, we talked about 25% tariffs, and this is peak tariffs, like our last guest said, but we have reciprocal tariffs, we have sectoral tariffs, we have Section 232 on steel and aluminum, we have fentanyl tariffs. So is it So like, is it peak everything? Are we going to keep the sectoral tariffs? Are we going to cut those? Are we going to make deals? So the level of uncertainty is unprecedented, and what Wall Street is basically doing is giving up. And they're basically doing the bull, bear, and base cases, right? So we can now be right in any scenario. Well, yes, we tanked the economy, and we had that in a report. Or, oh yes, it didn't turn out this badly, and now we should all own this stock. So they're really stepping back and basically waiting for the companies to sort of like hold their hands. You know, analysts always like to have their hands held. It's a little bit different than what I've experienced in the past. So the level of uncertainty is unprecedented. You use these words all the time. But it's just crazy out there. No one really knows what to expect. And so I'll get an email just to finish the story, and they'll say like, "Wow, UBS says automotive profits will go to zero in a worst case scenario. Why are you still recommending these stocks?" And the answer is like, nobody wants to like downgrade General Motors ahead of earnings. It's going to be a disaster. And then on Wednesday morning, Scott Bessent says, "You know what? Sectoral tariffs are gone." Mm-hmm. Because then you just look like an idiot. So everybody's sort of like, well, I guess we just wait to see what happens.
Well, we've seen a lot of disclaimers in analyst reports where they say, this is true at this particular moment in time. I've seen a lot of those disclaimers pop up. Things could change in an hour. Things could change by the time this report comes out.
Yeah,
people are hedging a lot.
So we have this conversation in the newsroom, just to interrupt you, like, okay, so the parts tariffs are supposed to come on Saturday, May 3rd. So like, well, when are we going to preview the impact? Do we wait till Friday or do we do it tomorrow after earnings? Because probably will be invalid by Thursday afternoon.
Yeah, this is a little slice of our world, Al. Thank you so much for joining us. It's always good to see you.
Thanks.
Appreciate it. Coming up, gold's blistering surge to highs is cooling off as trade war fears ease for now. We'll speak to an analyst on the other side about how you should be playing the precious metals. Stick around, more market domination still to come.
Gold is on the rise as investors eye progress on tariff negotiations. The precious metal hitting several highs so far this year, but our next guest seeing gains for the precious metal potentially being capped. HSBC Chief Precious Metals Analyst James Steele joins us now to discuss. James, great to see you on set.
Well, thank you.
So maybe big picture to start, James. Gold has been a clear, glittering winner in 2025. Why, James? What are the reasons that explain this move?
Well, I think, from the time that I started covering these metals decades ago, the same 12 or 15 factors drive them every year. The trick to looking at the market, I think, is to figure out which of those factors is in the driver's seat. And for the past couple of years, and especially this year, it's been geopolitics. And you get a lot of risk, and you get a lot of uncertainty associated with elevated geopolitical risk levels. And you're not really sure. It distorts capital markets. It does a lot of things. And gold being a hard asset and a safe haven will tend to be a winner out of that. And I would say, I wouldn't say it's the only reason by any means, but it's certainly a dominant one right now, geopolitical risk.
Something I'm really curious about is if the tariff risk starts to come off the boil, right? If we start to see deals being announced, is there still a scenario in which gold can continue to rise or at least maintain these levels?
Well, there could be, but that would remove one of the legs of the rally, without a doubt. I mean, one of the things that presses gold higher is economic policy uncertainty. It's not necessarily whether the policy is good or bad, which you could argue from whatever standpoint you are. It's the uncertainty that gold doesn't like. And if you take, for example, Mrs. Thatcher in the UK or Ronald Reagan in the US, there was clarity about what they wanted to do, whether you agreed with it or not. Right now, all the indications are, if you look at the geopolitical risk, or if you look at rather the economic policy uncertainty risk index, it's very high. And that's what's helping to feed gold. I think if we got some clarity on the tariff issue, that would help undermine it.
James, do you give your clients targets for the yellow metal? Do you say, okay, I think my year-end target for gold is X?
Well, we give a different sort of year ends. Averages is what we look at as well. But the market now is very dynamic, and we also are obliged to explain the fundamentals and the drivers. I mean, HSBC is a large bullion bank, and we have a lot of physical clients as well as a lot of investor paper clients. People like mining, jewelry companies, mints, et cetera, et cetera. So we have a very good idea what's going on in the physical underlying market, because very often, I mean, right now is a good example where the two, there can be quite a cleavage between the two at times.
Interesting. So the demand for physical gold, in other words, right now is not seeing the kind of enormous demand that sort of speculative gold is seeing.
I would argue that.
And what are the implications of that then in terms of future price action?
Well, one of the difficulties is that the investor demand is driven by hundreds or say thousands of fairly big individuals or hedge funds, portfolio managers, et cetera. And the physical market is bought and sold by millions of people worldwide every day. So it takes a long time for that to catch up. But last year, jewelry demand, which is 50% of gold demand, was down double digit. Coin demand is down because many people had already bought coins last year and the year before and the year before that. Small bar demand, I'll give you an example. The 10-gram bar is the favored bar in India, which is the second largest consumer in the world. And a few years ago, it was 35,000 rupees, and today it's around 100,000.
Wow.
So you can see how people would be priced out of that. Now, that accumulates, and we've had a lot of supply come on the market too. Because of recycling, it's very attractive to hand your gold back in, and mine supply is going up. But that doesn't necessarily mean the price will go down as long as the investment side, asset managers, central banks, portfolio managers, insurance companies, et cetera, and so far they've been happy to absorb that.
What have ETF inflows been like, James? Do you have line of sight there?
Well, the ETFs hit a peak during COVID at 111.5 million ounces. They went down to about 80 million ounces. They started this year at 82. They're up to 86, I think. But we have also seen an increase in Chinese-based ETFs. And that's been the big issue this year, I think. Although we've seen jewelry demand and things like that in China go down, we've seen the ETF demand has gone up.
And James, before we leave you, just quickly, so where do you think we're going from here? Do you have a particular, how much more do you think gold has to run?
Well, I think you hit, Josh, on the nail at the beginning. If we get any kind of a relaxation in geopolitical risks, any kind of clarity on economic policy, and if the dollar doesn't keep going down, then the market can top out a bit, but we're probably going to stay volatile and keep spiking to the upside until it's the second half of the year that we think we might see some more relaxation. Things are going to be too tense in the near term to get a big pullback.
2 tenths, good for gold. James, thank you so much for your help today. Appreciate it.
A pleasure. Thank you.
While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.